In this video, we're going to go over when to take profits and when to cut losses, though obviously this is more of a trading focused chapter. So why have a take profit? Why have a stop loss? Every professional trader has a profit target and a loss target, meaning each trade you enter should have a price in which you sell for a profit and a price in which you sell for a loss. Even the best traders still lose a good amount of trades. What makes a trader profitable isn't just how they manage their wins, it's how they manage losses. So when setting your stop loss and take profit, you must always consider risk to reward. You always want to have more reward than risk, meaning your stop loss should never be higher in terms of a percent than your take profit. The risk to reward ratio is a good way to kind of measure risk and reward. So it's basically in trading, this is used in trading, and it compares the potential loss of a trade to a potential gain. It helps traders assess whether the potential reward justifies the risk taken. When higher ratios indicating a potentially more favorable trade, so those higher ratios indicate a potentially more favorable trade. How can we measure risk and reward? Well, here's a simple example. So let's say our take profit is set up for a 10% gain and our stop loss is set for a 5% loss. The risk to reward ratio would be 2, which is definitely good. And you would figure that out just by putting the gain over the loss, and that would give you a 2. And then, so this is a really important note. So to break even, you only have to be right 30% of the time with this trading strategy, right? And then let's take a look at it flipped. So let's say we were taking gain at 5%. That's when we were selling, and we were also selling at a 10% loss. Our risk to reward ratio would be 0.5. And in this scenario, to break even, you would have to be right 70% of the time. So clearly, it's more logical. It makes more sense to have it flipped and have it so you only have to be right 30% or more rather than 70% or more. So it always makes sense to take more reward relative to your risk. And then one quick point I wanted to make about a trailing stop loss. So a trailing stop loss is a type of stop loss order that automatically adjusts as the market price moves in your favor. It helps protect profits by allowing the stop loss level to trail behind the current market price, ensuring that if price reverses, the trade is exited with a locked-in profit. So this is something always good to use on a trade, especially if you're deep in the green. So with all that being said, on the chapter there, definitely go through those quiz questions. If you get something wrong, always go back to the video here.